This is a class that Sean, you met Sean.
Yep.
He put together, me, Carmen, she's a loan officer on the team and she's Sean's primary assistant. And Don Jarecki all put together basically as just kind of a catch up on a lot of general knowledge, and then really tactics as we go into the shift. It's going to not necessarily turn from a seller's market to a buyer's market, but it's just going to get competitive for everyone. And it's going to get it's going to get tough with interest rates going where they are. There are a lot of tools that no one's really had to use over the last couple of years that I think are going to play a big role in future deals, winning the deal, making a deal work. You know, I wouldn't be surprised if how volatile interest rates are. We might have people getting into contract. They go to lock their rate's much higher. Maybe they have to pay a bunch of points. Where's that money going to come from? And to keep the deal on the books, we're going to have to figure it out. So that's what this is. Let's see here. So just a little bit about each loan type. These are the big four. Conventional probably makes up 70 to 75% of all deals. That's your over 700 credit score people. Those are people that are maybe buying their first home, but likely buying their second home. Hi there.
Hi.
Oh, no, you're fine. Are you going right here?
No.
Right here. So conventional, think of that as your grade A buyers. Over the last 2 years, those were the people that had an opportunity at every property because they're easy. Sellers don't worry about them too much. Now, the tools that we have within conventional that are good to note are, first off, recasts. A recast is a tool we have. It's not a loan program, it's a tool that if you're putting, let's say, 5% down on a property and you need to sell your current property to come up with a larger down payment, we don't need to wait. We'll just do the 5% loan now. And then when you sell your other property, you get that big windfall of cash. We can restructure the loan, adding in a bunch, or rather reducing your principal down a bunch, and we can adjust the payment accordingly. So if you run into someone that's saying, yeah, you know, I want to move, we're ready to move, it's the right time to move, but I'm worried about selling my house and I'm going to need to sell the house to put 25 or 30% down like I want to. Yeah. So if you were to, you know, buy a house now, qualified with 5%, you put the 5% down, we get you in the house. Sell your house whenever you're ready. You get that big windfall of cash and you're like, okay, Chris, I'm ready to apply this to my existing loan and recalculate the monthly payment. Easy peasy, it's $350 and a phone call and they'll do it for you. You have to put at least $10,000 toward your principal. That's the only real rule there, and you can go as much as you want. The only thing we ask is you don't pay off the loan in its entirety in the first 6 months after closing, because it won't reach its final destination. If it gets paid off before it does, they come back to us and they make us pay back all the commission and everything. Appraisal waivers, these are rare, but we do still get them. With basically the way it works is we run every single loan through an automated underwriting system. Think of it as a computer program that acts like an underwriter. It looks at the full credit profile, and generally the way we use it is it either tells us you're approved or take another look at the numbers. We need to adjust some things. One of the other things that's really nice about it is because every single loan officer in the country is plugging these houses in and these credit profiles in and running it through this system, it has an insane bulk of data for housing statistics. So it can break it down into neighborhoods and it can actually do its own comps. And if the price makes sense, the loan amount makes sense, that an appraisal really isn't necessary because we know that that value is out there, it'll flat out just tell us, hey, you don't even need an appraisal if you don't want to do one. A conventional is the only way you'll get that. You're going to need at least 20% down, and the more you put down, the more likely you are to get it. I got one just last month, 25% down, super easy. I'm trying to remember who got it. Adam Tursky. Adam Tursky's, it was a condo in Cleveland Heights, and we got a appraisal waiver on it. Investment. So you're probably going to have some investors out there right now looking to invest in property. If you do, they're going to need to go conventional or what we call non-QM. That's non-qualified mortgage. Think of that as like non-traditional, which I will get into that more here in further slides. Second homes and new jobs. The big thing about conventional with new jobs is they will let you start 90 days before you actually get on that job, and we can use that new job's income as long as there's no contingencies, meaning you took your drug test, you passed your licensing, and you have an offer letter where they're saying, yep, you're guaranteed a salary of however much. You don't even need to start for 3 months. I've closed loans with people that are living in New York that are not moving here until the end of the summer. Now we're there, but this is the beginning of the summer. So 3 months later, they're going to be moving here. We closed on their loan back in June because we knew they were going to be starting, all the contingencies were met, and the employer said, you're good to go. So FHA is a little tougher on that. Conventional is a little more forgiving. We still want to see 2 years of history of you working in a job of a similar capacity. It really helps us make the case if you're being promoted. So if you're going from maybe just sales to maybe a regional sales manager, and that's why you're relocating, we can do it. It's an easy sell, especially if you're a salary employee, you're guaranteed.
What about, like, for me, for example, I was a teacher.
Mhm.
I did this, and then obviously I jumped into still has everything have to be the same field.
Yeah, so I think you'd be fine because you had 2 years at least of history as a teacher. Are you salary in this position? Yeah, so that's easy enough. We would just get a letter from the office saying that you're a salaried employee. No problem there. FHA, a little tougher. They want to see more time on the job, on the new job. The bigger thing that we really run into is if you're part-time. So if you're a part-time employee, you just switch jobs. I need 2 years history of you being part-time, and we might need to wait 6 months for you being on that job before we're able to move forward. That's for FHA. Yeah. Oh, I skipped repairs on this. I'm going to go back to that really quick. Conventional with repairs. It is possible. Sorry for the angle, guys, on Zoom. It is possible that we run into some repairs being required on conventional, although that is pretty rare. Sellers out in the market worry more about accepting an FHA offer because of the stigma that comes with FHA and possible repairs required before closing. Conventional and FHA operate exactly the same when it comes to a few big items. If you find like cracks in the foundation, if it looks like there's an issue with structural integrity, exposed plumbing, exposed wires, standing water, and mold. No matter what, if it's conventional or FHA, if you have any of those items and the appraiser sees it, it's probably going to come up as something that needs to be repaired. What I like to say, and it's not a bad thing to say to your sellers, especially if they're investors, out-of-state investors, they just want to list this house and get it off their books and move on. If you're going to sell to someone getting financing through conventional or FHA, it needs to pass a general eye test of being habitable and safe. If it's habitable and it's safe, it doesn't have to be the most beautiful thing in the world. The countertops could be 60 years old. They don't care. They just want to make sure that it's safe. With repairs on FHA, there are really just a couple of big ticket items that I see come up most. That's cracked, chipped, peeling paint on outside, windowsills, decks, porches, door frames, things like that, any kind of posts or poles. Those will have to be repainted. And between me and you, they don't have to be repainted all that well. I've had people just go in and repaint them themselves. It just needs to look like it was taken care of, and most appraisers are going to be okay with it. The other thing is handrails. And if there's more than 3 steps, it requires a handrail. Sometimes that's as easy as just, well, the handrail's in the basement. We just haven't put it on yet because it was a reno or something. Well, easy enough. You just screw it in and there you go. Exterior, we run into this. My house, I bought it with a conventional loan, so this didn't come up, but there are 3 steps up to my like stoop basically, and then this 3 steps up to the porch. There's no handrail there. I think about it all the time. I'm like, if we bought FHA, there'd be a handrail here because that is required.
So the benefit of an FHA is just essentially lower rates.
Yeah, so I wouldn't even say it's a much harder inspection either. I mean, if you have sellers out there that you're listing their home and one of their big hangups is, well, I just don't even want to work, I don't want to deal with FHA. 1 in 4 deals that exist out there, 1 in 4 qualified buyers that are out in the market are FHA buyers. This market's going to get very tight. It's going to be, there's not going to be a whole lot of buyers and there's not going to be a whole lot of listings either. I would be hard pressed to say, okay, well, yeah, we'll just go ahead and cut 25% of every prospective buyer out just because we don't want to worry about putting a handrail in. Like, you could even stay ahead of it. You look at the house, you go, well, there's chipped paint on the front porch. Chris over at Cross Country said that's probably going to be a thing. We can paint it up front or you can wait and see. Like throw it out there. Why not? Most of the time, they get it done in a weekend and it doesn't slow us down at all. So.
How come sometimes sellers don't want to take an FHA buyer?
That exact reason. They're worried that something will come up when the appraisal inspection that's going to, throw a wrench in the deal. That's kind of overblown and a bad stigma that I don't like. The other thing is, some FHA buyers, generally, if you're going FHA, you're a first-time home buyer. You're probably, you've got enough funds to close and maybe not much more. And, if something were to happen, maybe we are extending closing on the back end because we're trying to figure out funds or, we're trying to get all the documentation together. I would say the last 2 years has created a huge stigma against FHA. I really hope, for everyone's sake, that goes away here in this kind of changing market. So a couple of notes about FHA, reasons I really do love it. It's 3.5% down, not only on single family, but all the way up to quads, all the way up to 4 family. The only catch is you have to live in the property. It's not an investment property. So I do this all the time. I have three buyers right now that are pre-approved shopping for a 2-family home, 3.5% down. They're going to rent out the other side. And guess what? We get to use expected rent to offset the mortgage. Yeah, super awesome tool, especially for someone that is trying to build some wealth in themselves here. They'll have that house for the next 4 or 5 years and then sell it. And it's going to be a huge down payment on their single family home. Super flexible on credit, 3.5% down. We can go all the way as low as 580 on the FICO score. You can go all the way down to 500 on the FICO score, but you're going to have to put 25% down. So most of the time we don't run into that. But if you have that rare case where someone's like, I have a ton of money, but my credit is terrible, throw it out there, have them reach out to me. I can, it might make sense. If they love the house and want to buy it, it might just make sense for them. Lower rates tend to come with FHA as well. VA, that's a veterans exclusive loan program, 0 money down. If they have their full eligibility through the VA, there is technically no max loan amount. Mm-hmm. First time home buyer.
Oh, okay.
Yeah, sorry about that. Yeah, I should note, with FHA, you technically don't have to be a first time home buyer. You just can't have another FHA loan. So I've had someone, literally, they were renting, they had 3 investment properties, all were financed through conventional loan programs. They wanted to put 3.5% down on their primary residence, and we got them an FHA loan. It's the 4th house they owned, but it was their first FHA. And then USDA, oh, I'm going to back up. With VA, repairs, very similar to FHA. Close time, some people worry, some sellers worry about VA, close times, paying for extra inspections, things like that. In the very recently, the VA has adjusted how they handle pest inspections. That's kind of a big one that comes up. Pest inspections are required. The buyer can pay for them. The buyer can set it up. The buyer can get it invoiced. We just need a copy of the invoice, and then we can show it as paid by the buyer on the closing disclosure.
That's on the VA.
That's on VA, yeah.
No question.
Hmm.
That's just for a spouse and the veterans, not their children, right?
That's correct. Now, there is kind of an interesting thing we can do. I just had one the other day. Felice Colon was the agent. It was dad's a veteran, qualifies for a full VA benefit. Son and his wife want to also be on the loan. They do not have veteran status. We could either go with dad by himself for no money down, the full VA entitlement, or we add the kids in there too. They just have to come up with half of the 20% that the VA would normally be covering. Because what the VA is really doing is covering a significant portion of the risk in the loan. So if the kids came up with 10% on their own, dad would still qualify for 10% of his VA benefit, and there you go. We're going VA. VA, excellent rates, super good interest rates too.
Spouses can get it though, right?
Spouses can get it, yep.
Even still with the rates from the
Yeah. And then, the big thing where FHA and VA help the most is conventional. If you see anybody advertising interest rates right now, they're advertising someone with a conventional loan, 20% down, grade A, perfect credit. With conventional, if you dip even below 700, you technically could qualify for that loan. You're going to throw up when you see the interest rate. I have a ton of people that are 680. They could go either way, but I flip them to FHA and the rate's so much lower, the monthly payment's less. It just makes sense to go FHA. What I tell them is work on your credit, pay on the house for the next year and a half, 2 years, call me back. Maybe we refinance you at that point into conventional. We'll get you out of the mortgage insurance and all of that. But yeah, there's options there. USDA, that is a no money down rural loan. Now, it's not for farms. Big note there. Some people think that, they could buy farmland with it. They could buy land. Now it has to be a house deemed in a rural area. I think outside of Cuyahoga County. No money down. There are some income limits. There is PMI, but it's extremely low. It's a good program. We don't do a ton of them just because it is kind of a niche product, but it exists. If you have someone looking out in a county that's outside of Cuyahoga and, they are,
A lot of things that were rural now, then are not rural now.
Right. Yeah. I want to say the income limit is 66,000. So if they're making, yeah. So if they're making under that, could be an option. Some extra loan types that might help you win the deal here. If someone is, maybe got a non-traditional situation, they don't fit into the FHA, VA, conventional bucket very easily. Jumbos, those loans are for anyone buying over $715,000 loan amount. It goes real high. It goes to like $2 million. They're going to require a lower debt to income ratio. The guidelines are a little bit stricter. We're going to need things like 2 years of tax returns, no matter what. Even if they're, regular salaried, let's say it's an executive at a bank or something, we're still going to need the 2 years of tax returns, even though they're going to be very boring. Rates can vary a little bit, especially with your situation. I'd say expect to put 20% down at minimum, or you're going to have a pretty high interest rate. The more you put down, the better. And yeah, so one thing to note, that 715 number, technically right now, is 647. Conventional maxes out at 647 until January 1st of this year. Cross country gets ahead of the game and offers us those up front. So for the next 3 months, I can go up to 715 on conventional. So some people think that maybe they want a $700,000 loan amount right now. They're going to have to go jumbo. Technically, I could get you in conventional right now. Doctor loans, that's specific to physicians, dentists, I think veterinarians. No money down, super aggressive on the adjustable rate mortgage rates. Great program. No PMI, it's awesome. The person that fits this perfectly is, do you know Match Day? Have you ever heard of that? Match Day, so everyone that's in medical school gets assigned where they're gonna do their residency. The clinic is a huge one. So a lot of people coming here from California, Texas, Seattle, Florida, they're all coming here to do their 4 years of residency at the clinic. The clinic pays $66,000 per year. I think it's graduated on each year. And that's like a salary they make for those 4 years. So they're not making a ton of money. They have about $250,000 usually in student loan debt. If they went to try and go conventional, it's going to look like they don't make enough because their student loans are too high. In comes the doctor loan. One, it's no money down. Two, I get to base the student loan payment that we hit them with off of their income. So that pretty much solves itself right there with this $66,000 salary. They can get an adjustable rate mortgage that's really aggressive, and it'll be locked for the first 5 years they're there. And then most people, maybe they're leaving Ohio, maybe they're sticking around, but whenever that big check kicks in on their 5th year and now they're making $250, they're not staying in that house. So if we locked them in at a lower rate for 5 years, we know they're going to move. There you go. You got them this house, you got another sale coming in 4 years when they're ready to move. And this program lets them buy now and build equity over that 4 years rather than renting while they're in their residency. So it's a super great program. Every year for Match Day, I wind up getting 3 or 4 of these loans because someone's coming in, they're calling around trying to figure out what to do, and eventually they get to me. So
how is the student loan forgiveness playing a part in that? Are you guys taking that into account, or does that have to go into effect before you can take it into account?
Yeah, so great question. I have been advising a lot of people that have a lot of student loans right now, not just doctors, everybody. Most people are getting some kind of forgiveness here in the next few months, assuming they apply. I've been advising everyone with dates too. Hey, October, this is coming out, apply for it.
When is that date? October?
October is when the application comes out. You can apply to have forgiveness. You can get on, it is studentloan.gov. Check if you're a Pell Grant recipient because you'll get an extra $10,000 there. It'll go into effect on January 1st. At the same time, a lot of my FHA buyers, they probably qualify for income-driven repayment. The new income-driven repayment plan is based off of half of what it used to be.
Oh, really?
Yeah, so they'll take your monthly income and use I think it's 5% as your monthly payment.
So it used to be 10, right?
Yeah.
10 or 11?
Yeah. So now that's half of what people were seeing before. As long as you have that agreement started and you make a payment on that, you can provide the letter that shows, yes, I'm paying this new income-driven amount. I can erase whatever's on the credit report and use that number.
That's your credit for those people that have already paid for student loans.
Yeah.
That's fine.
Yeah.
Government will never give money back.
Yeah, no kidding. So
Look at that.
yeah. But yeah, I mean, I've been advising people on the student loan situation. I talked to someone yesterday, literally told them, you have $20,000 in student loans right now that I'm hitting you with. in your monthly payment. If you apply for forgiveness and get that wiped out, there it goes, it's all gone. That just opens up that extra amount for you to be able to purchase here moving forward. So it's going to be interesting to see how they roll that out. I hope that it's a smooth transition, but we'll see. Bridge versus recast. Recast I talked about a little bit earlier. That's where, if you want to buy with a low down payment now and then restructure your monthly payment later with a larger, down payment, or rather payment on your principal. Bridge loan is perfect for someone that all of their equity is wrapped up in their home. They couldn't even really make a 5% down payment on their next home. So what we can do is, if they qualify debt to income ratio wise on both properties at the same time, we can actually loan them a short-term loan against the equity they have in their current property, so they can put a sizable down payment on their next property. All they have to do is sell their current property, pay the loan back. It's like a second lien. You pay both off whenever you sell the house, and there you go. It does have a 1-year time limit. You're going to need to sell the house within a year. You couldn't just hold that bridge loan indefinitely. So I prefer the recast. Most of the time, if I talk someone through it, we wind up going recast. Bridge loan's going to have a whole set of its own closing costs, probably somewhere around $2,000, maybe $3,000. The recast is $350. So it's a great one. First-time homebuyer programs. There's a bunch of them out there. As far as like down payment assistance or grant programs, you check your local municipality, they probably have one. The programs that I like to use the most are already built into conventional loans. They're referred to as Home Possible and Home Ready. It's Fannie Mae and Freddie Mac, the two big federal banks, kind of have their own version of it. At the end of the day, what it allows you to do is put 3% down. There's reduced PMI, and you get a huge reduction on your interest rate. The only thing it costs is the buyer has to take a free online class and send us the certificate.
Okay, you said 3% down.
3% down. You get a reduction on your mortgage insurance, and you get a reduced interest rate. I mean, the rate and the PMI are adjusted to where they're putting 20% down, basically. I mean, it's pretty awesome. There is an income cap on that. Cuyahoga County, it's about 68,000.
Again, per household.
Yeah.
You said 68.
Mm-hmm. And one cool thing they do is we can qualify them off of just their base income. Let's say they make $60,000 salary, but they also get a bonus or a commission every year. I can ignore the bonus and the commission so they don't get disqualified from the program. We just have to make sure they qualify on just the salary, and we're good to go. Other down payment assistance programs, we work with one that's specific to Ohio. It is called Communities First. They currently have suspended their grant program because of the volatility of the market right now. The way that it works normally, you would have to take their course. You would qualify for a 2.5 to 3.5% grant that would go towards your down payment in its entirety. In exchange for that, you're paying a little bit more in closing costs, not much, and your interest rate does go up a bit. You're taking a bit higher interest rate. The other big one that everyone hears about is OFA. That's the state of Ohio's down payment assistance program. That one actually places a second lien on the property that will stick with the property for 7 years. After 7 years, the state pays it off for them. So catch with that one, slightly higher interest rates, much more closing costs. To really make that program work perfectly for a buyer, I say you're going to have to live there and not refinance this property for 7 years. Are you okay with that? If they say no, it's out the door, because I would hate to push someone through this program without being fully upfront with them. If they go to sell the house, that lien has to be paid back in full by them. So, that could be a huge chunk of some of the proceeds they thought they were going to get from their sale. Now it's paying back that second lien that OFA is not going to cover. Yeah, the other catch is
7 years and 1 day.
yes, exactly. Yeah. Both those programs take a little bit extra time. I'd say it probably want to give us about 45 days rather than 30 days to do it. Just because we not only underwrite it, but we have to send the full file in for them to look at it too. MCC, this is something that I don't do a ton of. This is a credit towards your taxes. It's applied through the same program as OFA. But you basically, if you're under the income limit, you apply for it, they'll pay you back a portion of your interest paid each year as a reduction on your state income taxes. So you get a bigger refund. And there's a guy in our office that he's a slam dunk at it. He's really, really good. He would be able to rattle numbers off the top of his head right now. I'm not able to do that, but it'll save them at the end of the year, once they get their refund back, it could be hundreds of dollars per month. Didn't cost them a dime. They just applied for it because they were, you know, under a certain income limit, over a certain credit FICO score, and it worked for them. So a little known program. Non-QM, we'll get into that a little more. That's the non-qualified mortgage, non-traditional stuff. DSCR, this is going to become a big one here with investors. It's a debt service coverage ratio. If you have an investor who does not have income, or they have non-traditional income, or they tell you right up front that, hey, the way I make money is going to be, you know, hard to document, this program takes the investment property, the prospective rent that we expect to get out of it, if you have leases, even better, and then it compares it to the monthly mortgage payment. If the property gets more in rent than it costs to pay the mortgage, it's a go. We can do it. They have to have 1 year history of being a landlord. You have to have over a 600 credit score. Downside is there's going to be higher interest rate on it. But heck of a program.
We don't have to supply the verification of income.
Nope. It's a weird application. I mean, there's not even income, there's not even a debt to income ratio because there's no income. So it's literally just, does the rent cover the mortgage and then some, and you're good.
So if there's no mortgage on it, if they don't own it, they're free and clear.
We can refinance them if they wanted to, and they could pull their cash out using that same program without ever having to supply it. Yeah. So we do some of that too. Investors like, hey, I want to go out and buy a bunch of properties. They are cash heavy, so they go buy a bunch of houses. Now they call me and they go, I want to refinance all these so that I can get the cash back out of them and go buy more properties. All right, here we go. We'll do
So it's 600.
600 minimum, yeah. Gets a little bit better at 700. Because there's no debt to income ratio, we just look at that ratio between the rental income and the mortgage. So closer, the lower your score is, the higher it needs to be. So maybe the mortgage payment's $1,000 and the income is 1,500. Okay, well that's not bad. If it's only, if it's dead even, it's 1-to-1, you're probably gonna have to be over 700 credit score. This was kind of the biggest thing I wanted to talk about today. Seller concessions. I have a feeling that we're going to be seeing more of this as the market gets more competitive. We're at a point now where there are a huge number of people that were simply priced out of the market. They just can't afford to purchase with the current interest rates. There are tools to help people do that. And it's not necessarily always going to be just reduce the price of the house or, you know, just give them cash towards their closing costs. We can use seller concessions in a few different ways. We can buy down, obviously, their costs. We can pay discount points and buy them a lower interest rate. Let's say someone calls you, their biggest hangup is that rates are high. I don't want to buy a house right now because rates are high. Well, if we can find a property, in our offer include 2 percentage points to go towards discount points. So a $100,000 house, $2,000 to go towards discount points. You could buy that down with this volatile market right now, close to 1 full percentage point. Now, all of a sudden, we're not worried about interest rates. You got a great deal on interest rates and the seller paid for it. Lowers their monthly payment, lowers their lifetime interest. Maybe they feel a little more comfortable. PMI, same deal. Maybe they get a credit from the seller. We can pay off the PMI up front. One-time payment at closing, using the seller's money, PMI goes away. There are requirements on the max you can do. For conventional, it depends on the down payment, it's graded. So if you're putting 5% down, or 3 to 5% down, it's 3%, 20% down, it's 6, 25 or more, it's 9. 2% is the max seller concession on investment properties. That's kind of a big one. Some investors hate that rule, but it is what it is. FHA, USDA, 6%, no matter what. I love that. It's awesome because in most cases, people going with an FHA loan, that's going to cover all their closing costs and then some. VA is 4%. The other program that you're going to hear more of from every loan officer out there is a program called a temporary buy down. It is not a specialty loan program. It's the way we set a loan up. What it does, more often than not, it's called a 2-1 buy down. That means is, let's say the current interest rate is 4%. We're going to start the buyer out with the first year, their interest rate is going to be 2 points less at 4%. The next year, it's going to be 1 point lower. It'll only be 5%. And then in year 3, it'll go to the original 6% that we locked them into in the beginning. Now that's going to have a yearly differential there that we're going to have to make up for. How do we pay for that? A seller credit. The seller has 2%. They can put that into this program where, maybe instead of reducing the closing costs or reducing the price, we're saying we will fund, you're the list agent in this scenario, seller, let's get aggressive on the property. And maybe we're not having a lot of traffic. Let's throw it out there. Instead of a price reduction, maybe we lower the price $100 just so it pops up on the price reduction sheet. But we're going to throw out there that we'll fund a 2-1 buy down, 2% of the purchase price from the seller. And now anyone that walks in the door to buy that house, they know in year 1, they're going to have 2% lower interest rate than anybody else. The next house over isn't offering that. You're going to hear this program more and more. We had no reason to do it. It's been around forever. We had no reason to do it over the last couple of years, but it's definitely something we're going to hear more of. Super easy for us to set up. Literally would take me seconds to put it in the system and generate how much it's going to cost the seller and how much it's going to save the buyer. Super easy. So just a good one to have in your back pocket. Just some points in a shift. Good things to know. Renovation loans, you're going to get that. People are not able to afford as much house as they would normally. They're going to be still in the market, still looking for a home, but now they're looking at a lower price point. The first thing they're going to ask is, look, the house is fine, but needs so much work. Can I do that now? Yes. In short, you can. You have FHA 203K loans, both the simple version, which is non-structural, and then the full-on big one where they'll do everything except a pool. Conventional, super easy. All of those are in VA, I should note. Not a lot of lenders do VA reno, and we do. All of those go through a specific renovation department that we have in cross country. So like talking about nurturing your buyers, literally, I would hand them to a professional that's all they do. I've done a few of them over the years, and if the numbers work, I mean, the hardest part for buyers is it's a stressful process. Not only are you buying a house over the first 30 to 45 days, you're also finding a contractor, picking plans, picking out designs, what countertops and cabinets and flooring and all that. And then once they buy the house, then the 6 to 8 weeks of work starts at that point. So they have to deal with that as well. So
Can you give it to a retail, refinance?
yeah, you can.
Hey, Chris.
Find a niche. That's a big one, just because being the expert in an area is going to be super awesome for you, and just kind of setting yourself apart. I go to tons of loan officer conferences, classes. I listen to podcasts and insiders, and my industry and your industries are one and one. When if you're experiencing a shifting market, I am too. And one thing that they tell us is there's going to be less deals out there to be had. There are going to be just as many loan officers and realtors in that market competing. So setting yourself apart, educating yourself, taking advantage of the classes. Keller Williams is awesome for that, super amazing for that. That's going to give you the professionalism and the edge that maybe your peers at other brokerages and other, in this market, maybe they don't have, and you kind of set yourself apart a little bit and, show that you're the expert. Oh, good call. Let's see if I can open up. Where isn't that? Oh, there it is. What are the requirements for this temporary buy down? Do you have to live there for a certain amount of time? No, that is just the I don't know how to say it. It's just how we set the loan up. Technically, what happens is the 2% that the seller is going to provide goes into an escrow account to offset the adjusted interest rate. So the bank is still getting the same amount of money. It's being funded in a different way than just having the buyer pay the same interest rate year over year. Technically speaking, they could refinance before it ever maximizes to 6%. That's why this program is really cool. This is a great question because you're reminding me exactly what I missed, that they can start out at, let's say we'd lock it at 6, but they start at 4. Let's say it gets into the second year, interest rate bumps up to 5. In 12 to 18 months, interest rates are probably going to be coming back down. We could refinance them at that point and take whatever the new market rate is. The only catch is we can't refinance it in the first 6 months after closing because of that early payoff rule. And that's not a penalty to them, I should say. Just to be clear, there is no prepayment penalty. It's just that we're discouraged from doing it because we have to pay back all the commissions all the way down the line if they get paid off early. So yeah, I mean, requirements not really on the buyer side at all. If they qualify for the house, they can do the buy down, and it's just a matter of the seller being okay with funding it. Great question. I talked about rate buy down already. 10K price reduction versus 10K seller concessions. Running out those numbers for your buyers can be beneficial. Sometimes they only see the price, they don't see the bottom line, and it can help them kind of see how far or how much they're getting out of doing a concession rather than just lowering the price. Communicate with everyone in the transaction. That's something I do. Sometimes I worry that people hear from me too much. Ricky, your office is across from mine. You probably hear I'm on the phone all day long. I call people constantly just because I'm worried that someone is sitting there worried and doesn't know to ask me, or is worried, it doesn't want to sound dumb, or doesn't want to feel like they're bothering me. So I beat them to it and I just call everybody a ton. And then this is the full team. It's funny about us, the last couple of years have changed how the industry kind of works. It used to be an in-person thing. You'd swing by people's closings, you would have people come in and fill their applications in here in person, or they would, sign documents in person. Now everything's like 100% online. People close at their house. Like it's it's a digital, type of process. So you see me every day, but these are all the people on our team, loan officers, Sean in the middle, our fearless leader, processors, assistants. There's a few loan officers in there, but it's more than just me who's got, you and your buyers' backs. So just kind of a fun thing to let everybody know. Sometimes it looks like it's just me, but I couldn't do this by myself. Does anybody have questions? Thanks for coming. I appreciate it. Thanks for coming, Journey. Appreciate it.
Thanks, Chris. I'll probably talk to you again soon.